All right. Good evening, everyone. Hello. Okay, so everyone, can you see my screen? Give me a moment here. Okay, hello everyone. I'm Jeremy from Phillip Securities CFD, and along with me today, we have Benjamin also, who's also from the CFD department. So thanks all for joining on time, as well as on the Thursday evening. I understand that most of you still have work tomorrow, so really appreciate it. So today, the webinar, as you all know, would be we'll be sharing some of our outlook for 2024. All right, as 2023 is nearing the end, we really want to take this opportunity to share with you guys, three carefully selected trading opportunities that Ben and I have identified. All right. So, okay, before that, let me just take a look at the chat. All right. Anyways, just do a quick sound check as well as with my video check. Can you all see my screen clearly and hear me clearly? If so, help me type okay inside the chat so that I know everything is working fine. Okay, thanks, Casey. Okay. Okay, very good, very good. Today we have quite a number of people that joined this webinar. Yeah, quite a good attendance. Okay, thanks everyone for the response. So as I mentioned, today we really want to take this opportunity to share with you guys the three carefully selected trading opportunities that Ben and I have take the time to identify, and that you guys can actually take advantage of in 2024. All right. So both of us also concur with the view that no doubt that there will be an economic slowdown and possibly even a recession in the US in the year to come. So perhaps before I start, just want to get a sensing from the crowd here today as to how many of you think that there will be a recession in the US in 2024 or even beyond. Yeah, so if you think so, let me type yes. And if you disagree, let me type no inside the chat. Just want to get a sensing first. Yes, yes, no. Okay. Okay, a bit of a mixed response here. I'll say cannot be, could be. No, no, yes, yes. Sound is soft. I increase to 90 is still soft. Give me a moment. For the rest, is my audio soft as well? Soft also. Some can hear very clearly. Actually, just now I did a sound check. Everything was all right. Perhaps you can turn on your volume a little bit higher. Okay. Any issues along the way, please sign inside the chat. My colleague as well as my colleague Charmaine, she will help you with that. Okay. So I see that there's a mixed response as to some of you say yes, some of you say no, some of you say could possibly be a recession as well. So really a mix of response. So later I'll share with you why I think that there possibly could be a recession in 2024. Okay, next. So as usual, before I start, I just want to get before the start of the webinar, I just want to state a quick disclaimer. All right, this webinar does not serve as a professional financial advice. All right, so for professional financial advice, you still need to seek advice from a financial advisor after doing the appropriate financial assessment. All right. So here's the outline for the webinar today. Give me a moment. Okay, so firstly, I'll be sharing 3 reasons as to why we think that there could be a recession in 2024. Next, I'll share on the Federal Reserve fund rate outlook. Next, we'll be sharing 3 trading opportunities in 2024 that you guys could dive deeper into. And lastly, we'll also be sharing taking action using CFDs or contract for differences. All right. So I'll be starting off this webinar, and after which my teammate Benjamin will share with you guys more. Okay. So what you are seeing right now on the screen is actually the Wall Street cheat sheet. Okay, whereby it shows you how the emotions of the investors throughout the various cycle of the market. All right. So the only difference between a profitable investor and a non-profitable investor is how they actually control their emotions. Okay. While the latter always shows the right emotions at the wrong time and often leading to a wrong course in the market, the former actually understands their emotions and uses them at the right time. Okay. So to actually invest successfully in the market, you need to understand the psychology of the market, which is why we actually bring you this Wall Street cheat sheet, right? So this cheat sheet actually breaks down the psychology of market cycles and shows the different emotions that play out. Okay, as you all know, those that have been trading or investing in the market long enough, you should know that the market moves in cycles, and these cycles repeat themselves over and over again. Okay, this cheat sheet shows what goes through the minds of investors or traders during the different stages of the market cycle. All right. So by understanding the emotions experienced during phases like disbelief, optimism, complacency, anxiety, and panic, etc., this cheat sheet actually equips traders and investors with a comprehensive understanding of the market's emotional landscape. Okay, and this, I believe, this awareness will enable you as an investor to make more informed decisions or trading strategies while avoiding later. Ben will be sharing more on the this cheat sheet in greater detail. So if you want to find out which cycle we are in right now, you have to stay tuned throughout the webinar to find out. All right. Okay. Moving on. So as we approach 2024, let us take a quick look into 2023 and what lies ahead for the US economy in 2024. So though the economy occasionally stumbled in 2023, not good, it has certainly been resilient, and now nearing the end, the US is still not in a recession, okay, according to the traditional definition. So the National Bureau of Economic Research, or NBER, who is also the official recession scorekeeper, they actually define a recession as a significant decline in economic activity that is spread across the economy and that lasts for more than a few months. Okay, so the consensus view on global economic growth, and in particular on the US, remains rather optimistic, I would say. So most commentators expect a soft landing for the US economy, where the central bank successfully slows the economy down without triggering a recession, or only a mild one. Okay, so that's soft landing. Okay, so in fact, only 2 in 5 of the US economies actually anticipate any recession in the coming quarters. And international institutions like the IMF as well as the OECD actually sees moderating growth globally, followed by a rebound during 2024. So central banks' growth forecasts actually also concur. So the relative resilience of the economic activity so far, especially in the US, actually supports this optimistic outlook. A summer of easing inflation, abundant job opportunities, and strong consumer spending has also boosted investors' hopes that the US economy might achieve a soft landing. But we actually caution against taking current consensus forecast at face value. Okay, while a scenario of moderating growth or mild recession is undoubtedly possible, I think there are several reasons to think why things could turn out differently. All right. So if you understand this point, help me type face value inside the chat. Right. Okay, let's move on. Okay, so here are 3 compelling reasons as to why I think there might be a recession in 2024. Firstly, let's take a look at the Federal Reserve's poor track record of achieving a soft landing. Okay, while it is the goal, but the the Federal Reserve's track record has been pretty mixed at best. So if you look at the chart on the right side of the screen, it actually shows each of the Federal Reserve hiking cycle since the 1970s, okay, which is the dark green line on the chart. And the light blue line shows the US inflation. And the shaded graded areas along the chart are periods of recession, okay? And in most instances, aggressive interest rate hikes were actually followed, sometimes in a very short order, by a recession, okay? In fact, the only clear example of a successful soft landing was in the mid-1990s, when the central bank actually raised rates from 3% to 6% without crushing the economy, okay? And because the debate today is whether the Fed's ongoing monetary tightening will shove the economy into a recession, you want to keep in mind the intensity of the current rate hiking cycle. Okay, in fact, currently the rate hiking cycle is the second most aggressive run in the Federal Reserve 110-year history. So, in other words, apart from one rate hiking cycle in the 1980s, every other round of interest rate hikes has been less severe than the current one, okay? And most of them actually spark a recession, right? So if history is of any kind, the likelihood of the Federal Reserve achieving a soft landing, I would say, is pretty low, all right, looking at historical data. Next, there are some key leading indicators that are pointing to a recession, okay? So this is a signal that we get from firstly the inverted yield curve, as well as the shunt indicator, which I'll share more later on. Right. Firstly, let's take a look at the inverted yield curve. The rate of bonds with a different maturity and equal credit quality, okay, through yield curves. So even though yield curves can be plotted with bonds of any maturity, some of the most common ones, most common yield curves are the spreads between the either the 3-month or 2-year Treasury bill and the 10-year Treasury notes, which are used to indicate the spread between the short and long-term Treasury securities. So generally, a yield curve is upward sloping, as shown on the left side, the left chart, with short-term bonds offering lower yields and long-term bonds providing higher yields. In other words, you should be compensated with a higher yield when you tie up your money for longer periods, correct? And however, sometimes a yield curve can be inverted and start sloping downwards. as shown on the right side of the screen, the right chart. So when this happens, short-term bonds have a higher yield than long-term bonds, and investors are not rewarded for putting their money for a longer period of time. So when the yield curve inverts, investors expect the Federal Reserve to reduce its benchmark rate or the federal fund rate in the future, which actually drives down yields for longer term bonds. And an inverted yield curve is used to predict recessions because it indicates what investors think the Fed will do with its benchmark rate in the future, right? And every recession we have seen has been preceded with an inverted yield curve. And that's not to say that every yield curve actually pointed to recession. The yield curve did have one false positive since 1955, whereby in 1966 there was an inversion of the yield curve that was not followed by a recession. So looking at the spread between the 10-year and the 2-year treasury, the US treasury bond, on you can see on the chart on roughly around July 2022, the yield curve actually this yield curve, this spread actually became inverted, and it has stayed that way since then. And it has been more than a year since the yield curve inverted. So even though a yield curve of this duration has typically resulted in a recession in the past, I think there's a good reason to believe a recession has been delayed for reasons like the housing market remaining resilient and the strength of the labor market, right? So so far so good. If all is good, help me type inverted in the chat so I know you guys understand what I'm saying. Okay. Thank you for the response. Okay, now let's move on. Okay, so next, the sham indicator. Has anyone heard of this indicator before? Okay, maybe not. I'm not surprised because this indicator is less heard of, but you'll be surprised it is actually an important indicator watched closely by the Fed, and it essentially tracks employment. Okay, and this indicator is actually devised by the former Fed economist Claudia Sham, the lady on the right. Okay, hence the name Sham indicator. It shows the basically this indicator shows the difference between the current 3-month average unemployment rate and the lowest 3-month average unemployment rate from the past 12 months. Okay, so think of it as the trajectory of unemployment. The faster it rises, the wider the gap becomes. Period of recession, which is the shaded gray area. All right. So right now, this sham rule is standing at about 0.33%, meaning there is about a 40% chance of a recession. So if you are in the doomslayers camp, you have every right to point out that a 40% probability is pretty high, and that the direction of this indicator has been pointing towards the 0.5% number. Yeah. Okay. Next. So the third reason is that the Americans, their savings are depleting. Okay. So central to the soft landing argument is the fact that consumer spending, which accounts for about 2/3 of the US economy, has been pretty strong, right? And all that out of hand inflation should have turned the country off spending. Okay, then the argument goes on, but that hasn't really happened. Okay, not yet at least. But millions of Americans were able to save up during the pandemic. putting away saving up stimulus checks and government benefits, while skipping luxuries like dining out as well as vacations. So those savings actually, I would say, created sort of a financial cushion which helped them handle rising prices without cutting back too much. And that effectively has been shielding the economy from a recession. But as we all know, that money is bound to run up. Okay, and according to the latest Federal Reserve study on household finances, all but the wealthiest 20% of Americans have actually spent those savings and now actually have less cash on hand than they did when the pandemic started. And that said, this is definitely going to dent consumer spending going forward, which let's not forget is actually the engine of the US economy, since it actually accounts for about 2/3 of the US economy. All right. All right. So next, moving on to the federal fund rate outlook. All right. So in the latest and as well as the last FOMC meeting of 2023, the US Central Bank actually held steady for their policy rate, still within the range of 5.25% to 5.5%. All right. The Fed chief Jerome Powell actually said that the historic tightening of monetary policy is likely over as inflation falls faster than expected, and also with a discussion of cuts in borrowing costs coming into view. All right. So traders of the future contracts that settle to the Fed's policy rate are actually pricing in price rate cuts in March, okay, as well as end of 2024 policy rate, which is about 1.5% below the current level. Okay. And next, and this is the Federal Reserve dot plot, which actually shows the interest rate projections by the officials at the FOMC. So each dot represents a vote. So as you can see, this dot plot projection actually by the officials suggests that rates fall to the 3.75% to 5.25% range by the end of 2024. Okay, so overall consensus between the markets as well as the Fed is that the Federal Reserve is likely done with its rate hiking cycle, and the latest FOMC that we witnessed last week could possibly mark the effective start of a Fed easing cycle. All right. In fact, after the FOMC meeting last week, last Wednesday, the bond market actually took Powell's message and ran with it. The yield on the 2-year Treasury note, as shown on the screen, which is tied closely to the Fed policy rates expectations, it actually plunged by about 30 basis points. So essentially delivering a rate cut to the open market. Yeah. So this sums up the our view for the Fed fund rate outlook for 2024. Okay. So now here comes the trading idea portion, which I believe most of you guys are here for today, right? So before I start, can I check any one of you here today has some form of exposure to longer dated US Treasuries in your portfolio today? Okay, be it the 20-year or 30-year bond, or even through ETF. If you have, you let me know in the chat. And type a yes if you currently have some form of exposure to longer dated US Treasuries. Okay, Herman has some exposure. TLT, yes, correct. KC. So those that are in our Telegram group, you guys might have heard of this ticker before, TLT, which is the iShares US Treasury 20-year bond ETF. Okay, great. So as you all know, bonds weren't really doing their job these past 2 years. That is acting as a diversifying hedge in the 60/40 portfolio, because bonds were actually rising and falling in tandem with stocks, right? But now, after the But after, give me a second, but after the huge decline in bond prices and an increase in yields, they are starting to offer some real value. Okay. In particular, we believe longer dated US Treasury bonds may offer an important and compelling option for your portfolio allocation, thanks to their attractive risk to reward and potentially negative return correlation with equities and other higher risk assets. Okay. Okay. Okay, so let's start with look at the yields. So we have seen a move higher in yields and a move lower in price. Okay, remember bond yields go up as their prices go down. They have a inverse relationship. And it is not just those higher yields that are making bonds more attractive. And like I mentioned earlier on, the risk to reward in longer dated bonds has actually improved. This means that the upside potential in bond prices from a move lower in yields is actually much bigger than the potential downside move in if yields were to move higher. Okay. In fact, the risk to reward profile what we're having now actually has not been so good looking in over a decade. But before I share on the risk to reward profile of longer dated US Treasuries, let's first take a look at the basics of how bond works so that you can better appreciate why the risk to reward is much attractive in longer dated bonds. Okay, so the bond's duration actually describes the average time it takes to receive a set payment. Okay, so the maturity and duration for bond differs if there is a coupon. Okay, so for instance, if a 10-year bond has no coupon, its duration is essentially 10 years. Okay, but the higher the coupon, the lower the bond's duration as it measures the time needed to receive the total cash flow. Okay, duration also tells us one more thing, which is the amount a bond price changes with a 1% change in its yield. Okay, so if a bond has a duration of 8 years and interest rates were to increase by 1%, the bond price will decline approximately by 8%. So the duration of a bond changes at different level of yield because the time taken to receive the cash flow changes. And this change in duration is called the bond's convexity. Okay, and all things equal, a bond with a longer maturity will have a higher convexity than a bond with a shorter maturity, and thus will always have a higher price as interest rate rise or fall. Okay, so perhaps to give you better understanding, you can take a look at the chart on the right. Okay, in this example, the bond A has a higher convexity than bond B, which indicates that all else being equal, bond A will always have a higher price than bond B as interest rate rise or fall. Okay. Next. So now let's take a look at the longer dated US Treasury bonds. You can see that the risk to reward looks particularly favorable. So if you focus on the 20-year Treasury bond, it currently yields around 5%. Okay, but if yields were to fall by 50 basis points, the same 20-year bond would return about 11.3% over the next year. Okay, and on the other hand, if yields were to rise by 50 basis points, they will lose just 1.1%. So this gives us a risk to reward ratio of about 11 to 1. And this risk to reward profile is one of the reasons why the iShares 20-year 20 plus Treasury bond ETF, or the ticker code TLT, could be a good investment right now. So in fact, my team and we have actually been shouting out this ticker, and for those who attended my colleagues Jack's webinar back in April, would probably have heard of it as well. And for those who are in our Telegram channel, you would have heard of it during my live session in November. Okay, and as mentioned earlier on, the Fed rates likely have peaked and reached its terminal rate. And as we see the Federal Reserve possibly starting to cut rates in 2024, bond yields will start to drop and bond prices will get a boost, especially in longer dated bonds such as the 20-year or 30-year US Treasury. Okay, in fact, the markets have already started to price in for the possible rate cuts. All right, For TLT, since mid-October, it has already delivered a return of more than 10%. All right. So if you understand what I'm sharing, help me type TLT inside the chat for you to internalize, and you can take a look at this counter in the deeper details after this webinar. Okay, thank you, WL Ng. Oh, only WL heard of understand TLT. Okay, thank you, Siu Miu. Okay. So next. So let's say we compare the risk to reward to shorter dated treasuries such as the 2-year treasury, the potential payoff is actually much balanced. Okay, you can see that for a 50 basis point move downward in yield, the return will be up about 5.5%, and a 50 basis point increase in yields will actually provide a return of 4.6% return. So it's much more balanced as compared to what we saw in the 20-year treasury risk to reward profile. Okay. Also, as discussed earlier, in view of a possible recession, another reason to look at bonds is the return of the classic 60-40 portfolio, where you actually allocate 60% in equities and 40% in bonds for your portfolio. So historically, bonds tend to act as a portfolio anchor, giving investors the stable income and relatively low on negatively correlated returns to the equity markets. Okay. However, that relationship was actually upended in 2022. So during the fastest and largest interest rate increase cycle since 1974, the bond and equity prices actually moved largely in tandem. Okay, and actually sustain historical losses. So as the Fed nears its terminal rate, we believe bonds are well positioned to assume their traditional role as a portfolio diversifier. So the return in correlationship displayed above actually illustrates the valuable role that bonds exposure can play in reducing portfolio returns, in reducing portfolio return volatility relative to the money market funds. So with higher yields and income, the classic 60-40 portfolio could once again become dominant. All right. So if you understand this portion as well, how many type 60-40 inside the chat? Okay, thank you, KC. Thank you, WL. Thank you, Yu Weng. Thank you, Victor. Okay, I see a lot of familiar names. Great. Okay, so with that, now I will hand over to Ben to share more on the other two trading opportunities, as well as touch more on the market cycle cheat sheet, which I shared at the start. Okay, and as I mentioned earlier on, we do have a Telegram group channel where we also do weekly live sessions on Friday. So if you're interested to join, then we'll be sharing about the link to join inside the chat as well. Okay, Ben, over to you.
Okay, hello guys. I see a lot of familiar names. First, Victor, Salong, Lin, Casey, EG, Siumui. Hello, it's good to be back. Okay, so if you can hear me, you can see my screen, type yay in the chat. Yeah, must try to match my energy, okay? I just recovered from a long bout of COVID and I can't wait to get roaring. So guys, show me some enthusiasm also, all right? Yes, Victor. Yes, thank you. Thank you for all your well wishes also, right? In our Telegram channel. You guys really, really rock. Yes. Okay, great. So I want to find out who is in our Telegram channel. If you are, type me in the comments. No, not comments, chat. Okay. Victor, great. KC, WL, great. Great. Then you're wondering, for those who are not inside yet, right? You're wondering, what Telegram channel is Jeremy and I talking about, right? Okay, don't worry. I'm sharing it with you over here. So if you can see, on November 10th, okay, this 11, but on the 10th, Jeremy shared, he did a Telegram live session. He shared about why it is a good time to buy bonds, right? So whatever Jeremy shared just now is actually true, right? He actually shared a Telegram live session on why it is a good time to buy bonds. These are the three main discussion points. And this is not just a once-off basis, okay? We also share a lot of useful and valuable information, such as an economic calendar every week. And we share about the signs, the things that we see, market updates. Okay, like this. I shared that Meta, Amazon, Meta, Amazon, Microsoft, right? They hit a new 52 weeks high. But pay attention because RSI is very high also. Okay, and soon after, they really pulled back a bit. Okay, and fast forward all the way to today, a lot of educational things, a lot of insightful things, all right? Warnings to help you protect your earnings, to help you identify that this may not be the best time to buy stocks yet. Okay, so guys, those in the Telegram channel, if you find everything to be so helpful and useful, type useful in the comments. Chat. Comments is for Telegram. Chat is for Zoom. Okay. If you find the things inside useful, please type useful. So more people will know that it is really helpful, right? All these analysis, reviews, follow-ups. All right. And because it's useful, right? I'm going to share with you the how you can join. Okay. So this is how you can join. Hang on. Why cannot copy over? Okay, never mind. Let me see.
No worries, then you continue. I will paste the invite link inside the chat.
Okay, thanks. I wanted to show you a QR code so it's easier for you to scan, but it's okay. Guys, so check out the chat. All right, Jeremy is sending the URL over. Click on it, join us. It's totally free. Okay. Okay. Now, this is the moment I think all of you have been waiting for, right? Should you enter TLT now? Should you consider buying TLT now? So to do that, of course, let's look at the chart. And what Jeremy has shared just now in the past 15, 20 minutes, okay? I believe this is supposed to be a longer term play. All right. So you can choose to look at the daily chart, but I believe it is more effective if you look at the weekly chart instead. All right. So if you understand this, type weekly in the chat. Okay, to help you remember that we are going to look at the weekly chart of TLT. Okay, and for those who are joining us for the first time, I have two screens. Okay, so occasionally I'll look left and right. It's not that I'm distracted. Okay, I'm referring to the things I have on both screens. Okay, weekly, great, awesome. Okay, so now you can see, right? TLT has been on a prolonged downtrend. All right, downtrend. But the past month or so, since late October, it has been rising very strongly. Can you see this? If you can see this, type yes. Okay, the downtrend, and then the sharp rise up. Okay, we must agree to this first. You must be able to see also. Okay, now I'll put on my drawings. No wonder I hid my drawing so the QR code all hidden. Okay. Now, I think we think that TLT has found a bottom at about $82.78. All right. Now, because it has already risen by so much, let me ask you, should you be looking to buy it now? If you think yes, type 1. Okay. If you say no, type 2. After the price has risen by so much, should you be looking to buy right now? Right now, right now means maybe tonight or next week. Okay. So if you say yes, type 1. If you say no, type 2. I want to have a sense. Okay. Most of you type 2. A few of you type 1. Wai Chan says, wait for the RSI to drop back to 20 and rise from 20 again. Okay, good. Good. So it's heartening that you guys are paying attention to the RSI and the price movement. For every big price movement, right? Okay, that there is a high chance, a good chance of a pullback. All right. So let me move back in time, or let us go back in time together. Okay, you see, after every big move, there is a pullback or small correction. Big move, pullback, small correction. Same thing. And let me use the pen to mark it out for you to see. Big move, correction. Big move, correction. Big move, correction. Do you see it? If you see this, type yes. Okay, very important. So what am I trying to say? I'm trying to say don't kanchong. Don't worry. Okay, whatever goes up has to come down. Maybe not down to earth, but at least come down a bit. So now it has gone up by so much. Let it maybe come down a bit before continuing going up. Is this clear so far? If it's clear, type clear in the comments. In the chat. Clear, huh? Okay, then the next question you'll be asking. Okay, go down, correct to where? Okay, where is a good guess? I think it could come down to somewhere about 90, 94, between 90 to 94 lah. All right, before going higher. Okay, now please note that this blue price action arrow is a simplified version. Okay, the price of TLT may not come down so smoothly, and it may not rise up so smoothly. Okay, but this is what I think may happen. So you can be looking to enter at a bounce of maybe about between 90 to 92, $94. Okay, and by then, when it comes down to about 90 something, right? 92, $94, right? The RSI would probably be at about 30 something or 40 something, which is reasonable in a bull market. In a massive bull market, if the RSI drops to below 30 or below 40, it can be very worrying because it means that the correction is very deep. Could even be like a 40% or 50% correction. All right. Is this good so far? If you think that this is good, type good in the comments. No, not comments, chat. Can This is why Jeremy and we wanted to postpone the webinar. Because at that point, last week, at that point of time, I had totally no voice. Really no voice. And we couldn't give you our best. All right. So we really applaud you for accepting the postponement of this webinar. Okay. Wai Chan, can we use stochastics in place of RSI? Of course. So you can choose any momentum indicator as long as you understand what this indicator is telling you. You know how to read it. You can infer it. You can infer the message it is sending to you. Okay. So you want to use MACD, no problem. Go ahead. It's all about knowing what it is and knowing how to interpret the signals it is sending to you. Okay, Ken, Wai Chan? Can Great. Okay. And we have two other trade opportunities. But before we touch upon the two trade opportunities, I would like to share with you about the US market. If that sounds exciting, type US in the comments. Well, not comments, chat. Okay, type US in the chat. Because if it's not exciting, then I don't share it. Don't bore you to death. Okay, great. Now, for those who have been following us for some time, I'd like to take a look at the S&P 500 futures. Okay, so instead of taking at the weekly chart, let me take a look at the daily chart first. Okay, now do you notice something? Do you see these uptrend lines, these three uptrend lines? Okay, and you see the value of the S&P 500 futures so nicely hit here and got rejected down. Okay, and you can see that the RSI level, is it high or low? Can you type in the chat, high or low? Very high, right? For the past 2 weeks, we are seeing RSI values above 70, 78 81 right? Very, very high. So it's about high time that it pulls back. Okay, will a Santa Claus rally happen? Maybe to this Thursday, tomorrow. Maybe. Okay, maybe. Anyway, it has already run up so much. So if it pulls back a bit, there's still the Santa Claus ready. Okay. Can? So the moral of the story is try not to be too gung-ho in the stock market. Clear? If this is clear, type clear in the comments. No, not comments. Chat. Clear? Now let me switch to the weekly chart. And it's also very interesting. Now on the weekly chart of the S&P 500 futures, okay, can you type in the chat the RSI value right now? Okay, let me circle it out here. Type this figure out. 6490. Yes, also very high. So when the weekly chart says that the RSI is that the S&P 500 futures, right, is near the overbought territory of the RSI, and the daily chart also gives you the same thing. Yeah, you know that a pullback is near. Okay, it is due for a pullback already. Can? Okay, then you must be thinking, what is it? What has all this got to do? Oh, when the overall market, right, pulls back, it means that the stocks that you're holding, the likelihood of them pulling back, of them dropping in their price is quite high. All right. Although I cannot give it 100% certainty, but the likelihood is high. Okay. And I want to bring your attention to this. Let me share the image that Jeremy shared right at the start. Okay, this. Okay, let me adjust. Why? Because I want you to be able to tell me which stage are we at now. Okay, so now looking at the chart here, right? Okay, the chart of the S&P 500 futures. Which stage do you think we are at now? Okay, who thinks we are at thrill? Type 1, euphoria. Type 2, complacency. Type 3. Oh, you all say complacency. Okay, good. At least you identify that we are at the top here. Nobody tell me none of the above. If you tell me none of the above, that means you think it's here, or even here. Okay, so at least we are in agreement. We are maybe in between 2 and 3 somewhere here. Okay, okay. So if you agree, type 2, 3. Okay, 2, 3. I think we are in between. Coming to complacency soon already. Can Okay, I see a question regarding TLT. Let me take a look at it again. Okay, Wai Chan asks, does the TLT have 2 or 3 times leverage ETF? Yes, there's one ETF that is leveraged. We will share in the Telegram channel. So, Wai Chan, if you are not inside, I encourage you to join us. Okay? Okay? Maybe Jeremy, you can drop the link to our Telegram channel again in the chat. Okay, so we all can agree that we are somewhere in between euphoria and complacency. Now, why does this matter? This matters because what follows next is what? Is a drop. It's a steep drop. All right. What follows next is maybe a gradual, a bit of a rise first, then a steep drop. Now, knowing this allows us to prepare ourselves to pivot away, okay, from the aggressive stocks. Okay, can and I have two, or Jeremy and I, right? We have come up with 2 trade ideas that you can potentially benefit in this period. Okay, so if you are ready for the next 2 trade opportunities, type 2 in the comments, in the chat. Okay, I join your Telegram channel. Fantastic. Okay, great. The first one is XLE. XLE is the energy sector. Okay, XLE. So Jeremy and I, we went to take a look at XLE and we discovered that there's something that you can use to your advantage. All right, there's a small pattern here. Now on the left, this purple line on the left, okay, 20th of March, year 2000. That's when the S&P 500, right, peaked out. Okay, that was the top of the S&P 500 before the dot-com crash. Okay, then on 21st of May, this purple line over here, this is the peak of XLE. Okay, okay, okay. Moving ahead of time, 8th of October 2007. This was when the S&P 500 was at its peak. 19th of May 2008, this purple line, this is where XLE, the energy sector ETF, is at its peak. It was at its peak. What do you notice? What do you notice? Do you notice this? When the market started to drop already, XLE was still rising in year 2000 until May 2001. That is 1 year, 2 months. Okay? And here, overall, the value, the price of XLE also increased, also rose in a span of about 8 months. Do you see this? If you can see this, type yes. This is important. Why? Because if history were to repeat itself, okay, 3 times in a row, hat trick, what can you reasonably expect? You can probably expect XLE to be bullish. Okay, when the market starts to come down, XLE is likely to continue rising. And probably within maybe a few months later or 1.5 years later, right? Energy this energy sector, the price of this energy sector could start to fall. Okay? So this is one ETF, one trade idea that you can hold with you. Okay. Because now the market is overheated, I think that you'll be better off waiting. Now this is the weekly chart, okay? The RSI is in the neutral zone, 47. Daily chart 50, also neutral zone. Okay. But do you notice something? XLE, I think it could be going sideways for a while before going up. Okay. Therefore, I think this is likely to happen. Drop to about 78. Okay. Go up to about 93, 92. Face some resistance, come down before eventually hitting, what's this price? About $100. Eventually hitting $100. So now, what we think, right, is be patient lah. Wait for it to drop to about 78. Then you can consider if you want to enter at about 78 on the bounce up. Okay, enter here. If you want, you're comfortable, enter here using the weekly chart. Put a stop loss of how many times ATR. Okay, I would put maybe 3 times the ATR. All right, so you do your calculation 3 times. Let's see. Now the ATR value is 3.78. Let's round it up to 3.8. Okay, so 3.8 times 3, that's 1140. Then let's say we enter at about 79. So 79 minus 1140. Okay, 79 minus 1140, 6760. Yeah, they're about there. 6750, 6760. Okay, put your stop loss here. You can either take profit at 92 plus, or take partial, or wait, right? Shift your stop loss up when it's there, shift it to somewhere here, and see whether it continues to rise to about $100. Is this trade idea clear? If it is, type clear in the chat. Casey Neo, what's the relationship? I don't know. It just behaves like that. A lot of things we don't have a clear-cut relationship. Even for bonds, right? There's no clear-cut inverse relationship. In textbook, yeah, they always tell us that it is an inverse of the stock market. But in recent years, it hasn't been showing that when the stock market goes up, bonds come down. Okay, but when the stock market come down, bonds also come down. So, okay. E.g., I see the entire correction as a barrier triangle with a break to the upside too. Yeah, good. I think you are referring to this triangle, is it? Then this one over here. E.g., let me know if you are referring to this. Yes, okay, can. Good, good. Can Then, when it reaches 100, right, and when the stock market already starting to crash, starting to drop, you can consider shorting, right? Because when the stock market crashes, it takes about, usually the price usually drops for 1 year, 2 years. Okay. And you don't want to be sitting on the sidelines 1 year, 2 years, not doing anything. Okay, let's see. Let's go back in time. You see it drop. When it started to drop, 287 days. So this is about 1 year. This business days. So it's maybe 1 full calendar year. Okay, or close to 1 full calendar year. What about here? From here to here, 427 business days. So it could be like almost 500 calendar days. That is 1.5 years. Okay, so I don't think you want to sit on the sideline and eat popcorn for 1.5 years. Maybe you can take it, I cannot. All right, so I suggest once the price of XLE, right, is maybe at 100 or slightly higher, you can look for shorting opportunities. Okay, maybe here, and then it shows that no strength already, coming down already. Okay, look for shorting opportunities. And this can be done very easily using CFD. Okay, can you type CFD in the chat? Okay, type CFD so you remember that, yeah, there is a possibility of making money as prices drop. You don't need to lose money together with the market, or you don't need to stay out and then see other people make money, but you never make money. Okay, I'm sharing with you a possibility. All right, now then the stop loss, right? Same thing. You can choose 3 times ATR. Okay, but not too small a multiple, like 1 times ATR, 1.5 times ATR. I think you'll be stopped out quite easily, and then the price will continue to drop, and you'll be thinking, how come I cannot make money? All right, it's not you cannot make money, your stop loss is too tight. Okay, Casey Neo, CFD versus options. CFD more straightforward lah. Options, you got to deal with the 4 changing elements, delta, gamma, theta, and vega. So it can be pretty confusing and pretty stressful. Okay, and then you may want to roll and roll and roll. Wow, don't know can repair or not. Okay, can CFD more straightforward. Okay, now the next one is XLY. XLY is consumer discretionary. Okay, now this is the weekly chart of XLY. Let's take a look at the history. In year 2000 and during the dot-com crash and the great financial crisis. Okay, so same thing. The line on the left, right, represents the peak of the S&P 500. No. So, no, sorry, March 2000. Okay, it is the peak of the S&P 500. So now you understand, consumer discretionary always fall first before the market drops. Okay, always drop first before the market drop. In 2007, it's the same. The market peaked, the S&P 500 only peaked in October 2007. But XLY, consumer discretionary sector ETF, has already been falling. Okay. Now let's look at today. The RSI is quite high on the weekly chart. Daily chart, super high. Okay, so if you are thinking of buying XLY, be a bit more careful. All right. I think there is still a bit of room for it to go up. So it could, this is the weekly chart, okay, it could come down a bit before going up all the way to 200 plus. Okay, it may even exceed. It may even exceed. And again, this is a simplified drawing. It may struggle midway. Okay, it may even cross 200. Please, now that you are informed, would you want to buy at 180 something or even 200? If you think you will buy, type yes. If you think no, you are going to stay out, type no. Okay, it's either yes or no. Yeah, no lah, right? I don't think it makes sense to buy, right? So wait for it to pull back. If you really want to buy, okay, I think a safer area to buy is at the bounce at about 172.5. Can? Okay. If this is clear, type 17250 in the chat. Because this is a price area that I'm looking at. Okay, not so high, not at 184, 185, not at 200. If you want to buy from there, I think a lot of people want to sell to you. Okay, and same thing. Now we know that a recession is coming. So these are all shorter term trades, short to mid term. That means few weeks to probably a couple of months only. Okay, I need to qualify this. Few weeks to few months only. And XLY, you gotta be more on the ball. Okay, because once it reaches that high, I think the likelihood of it coming down is very high. Is even greater. All right. And when it comes down, it can come down very fast over a period of also probably 1+2 years. All right. So same thing. If you have CFD, great. You can make use of it to probably short it at about 200. When people are buying, you sell to them already. After you sell to them already, you can flip your position to consider shorting. Okay. When the setup is there, consider shorting. Is this trade idea clear so far? If it is, type clear in the comments, in the chat. Okay, let me bring you back to this again to re-emphasize. Now, you see this? There's a sharp rise, a pullback, right? Then people thought, wow, buy the dip. But then their TP is here or even higher. Then they realize, oh crap, I'm stuck now. And as price drops, they are stuck. Okay, so always have a stop loss. Always, please, always have a stop loss to protect your trading capital, to protect your mental health, to protect your emotional health. Okay, I think about 3 weeks ago, before I contracted COVID, I talked about the 4 benefits of having a stop loss. I shared it over Telegram, and if you really want to get the recording, it's there. Join our Telegram channel. Very easy, free of charge. Okay. Who remembered that I shared this in Telegram 2 or 3 weeks ago? Type SL. SL to symbolize stop loss. So yes, good. Okay, very important. I don't want you to feel so stressed. Not nice. It's not a nice feeling. If you like to feel stressed, then go ahead. Good for you. I don't like. Not many people like. Okay. Now, lastly, if you want more of such insights, I encourage you, strongly encourage you to open an account with us. Why? When you open an account with us, we give you higher priority to meet us for lunch, for tea break, right? To either go through your portfolio, to bounce off trade ideas, to talk about investments. Yeah, right. So yesterday, I went to meet a long-time customer of ours. And this customer, this lady, she introduced her husband to us, and her husband transferred his account to my team, right? Because he knew that if I transfer over, he can sit into the session and he can get a lot of value from us, right? Because Jeremy, Jack, Minghan, myself, we have been doing content for so long. We have been spending so much time doing research, calculating, analyzing, and we are so generous in sharing it with you. So if you want continued support, if you want continued deeper personalized insights, okay, scan the QR code, open an account with us. All right. If your account is with someone else, you can choose to transfer it over to us. Because if your account is with another team, Jeremy, myself, Jack, Minghan, we cannot see any details. Therefore, we cannot advise you at all. Is this clear? If this is good, type good in the chat. Good. In fact, I'll be meeting another client tomorrow. Right. He also transferred his account over because his brother is his brother's account is with us, and he find that wow, there's a lot of value that our team can provide him with. He's impressed. He got his brother to transfer over. Okay. Good, huh? All right. So with this, we conclude our webinar. Thank you so much for your time. Thank you so much for your attention, your participation. Okay. And thank you for allowing me to overrun by a little bit. Okay, guys. So with that, thank you so much. Take care. We'll see you again soon. Okay. Bye-bye.
Thank you.